Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 13th of June 2021, and we're looking at what the Fed is likely to announce during its FOMC meeting on Wednesday and what impact that may have on equities and precious metal prices. So let's take a look. Okay, so in our weekly update published yesterday, and we put a link below, we highlighted the fact that the FOMC of the Fed will be mentioning or announcing any change in interest rates on Wednesday. And that will be followed by the chair of the Fed, Jerome Powell, actually publicly speaking at a press conference. Now, today, Sunday, June 13th at 1 p.m. GMT plus 1, we can see an article published by Bloomberg. It says Fed dot plot seen shifting to 2023 rate liftoff, economists say. So let's just take a little look at this, because one of the concerns, both the markets, the dollar, I'm talking about the forex markets, the equity markets, and also investment managers generally, the concern they have at the moment is how soon will the United States raise rates? And this particularly affects us who are collectors of gold and silver, especially if we want more, as to whether rates will go up. Let me rephrase that, as to whether the price of gold and silver will go up or whether it will go down. And looking at this article, we'll read a little bit of it. Federal Reserve officials this week could project interest rate liftoff in 2023 amid faster economic growth and inflation. But they won't signal scaling back bond purchases until August or September, according to economists surveyed by Bloomberg. Now, we mentioned in our weekly update that we envisage that the Fed will not be raising rates. Obviously, I don't think that's a great sort of prophecy to make. However, we did mention that we suspect they might be marginally hawkish. More than half predict the quarterly rate forecast dot plot, released after the conclusion of the Fed's two-day policy meeting on Wednesday, will show the median of 18 officials penciling in at least one 2023 increase. The remainder see no liftoff from near zero rates until 2024 at the earliest, mirroring the Fed's forecast in March. And these 51 economists were surveyed on the 4th to the 10th of June, so it's pretty up to date. Now, interestingly, we pointed out also that the large concern is, of course, inflation. And the Fed and various investment houses are talking it down, saying that the annual rate of 5%, which is what we saw towards the end of last week happen, is just a temporary blip, and that rate may very well fall, and it might indeed do so. But we have to bear in mind that the Federal Reserve is looking at maintaining inflation at or around 2%. So 5 has to drop quite considerably to get it down to 2. Now, we know, based on previous statements, that they are willing to allow, for the want of a better term, rates to remain above 2% for a reasonable amount of time until, in their view, the economy is back on track. So why are they talking about rate increases now? Because the more of an impression they give that rates are going up, then arguably that will have a detrimental effect to potential growth. Or will it? Even so, the poll respondents see no rush by the Fed to scale back monetary stimulus. Some 40% expect the Fed to take its first step towards tapering its current $120 billion in monthly bond purchases in late August. So, leaving interest rates entirely alone, but cutting back or tapering its bond purchasing, which is what happened after the last economic collapse. That's when Chair Jerome Powell could give an early signal at the Fed's August 26 to 28 policy retreat in Jackson Hole, Wyoming, if he follows tradition and speaks there again this year. Another 24% see that happening the following month. So, the FOMC is expected to reaffirm plans to only adjust purchases once the US economy achieves substantial further progress towards its employment and inflation goals in its policy statement released at 2 p.m. Washington time on Wednesday. Nor is the Fed expected to raise the target of its benchmark rate from a 0 to 0.25% range. That's the Fed funds rate. Powell will hold a virtual press conference 30 minutes later. Quarterly forecasts are likely to show the FOMC's economic growth outlook raised to 6.6% for 2021, and inflation estimate increased to 2.7% for this year and 2.1% in 2022. So the 5% that we're currently experiencing really does have to drop. The unemployment rate may fall to just 4.7% by the fourth quarter this year, a slower pace than seen in March, the economists concluded. According to John Sylvia, founder of Dynamic Economic Strategy, the Fed continues on its easy path as unemployment remains above its target and progress on lowering the unemployment rate is slow. You see, we saw employment increase, according to this, by 559,000 last month, less than economists expected, and the unemployment rate edged down to 5.8%. A number of Fed officials, including Vice Chair Richard Clarida, have said the committee may discuss tapering in upcoming meetings depending on the flow of data. A couple, including Dallas Fed Chief Robert Kaplan, have urged the discussion start sooner rather than later. Of course, they can have the discussion, but ultimately they have to have a majority have the vote. The survey shows a Wall Street consensus is building for some kind of hint of scaling back bond buying at the Kansas City Fed Symposium at Jackson Hole. That's a bit more specific than the April survey, which showed a plurality expected a third quarter signal. Economists are split on when the actual tapering announcement is most likely, with 1/3 predicting September and another third saying December. I've pretty much no doubt that they will potentially allude to having these discussions, but of course whenever they announce or introduce that tapering, is going to be critical in terms of timing. We only have to remember just a few years ago, they actually raised rates in the December, and that caused quite a crash the following January in the equity markets, forcing them then to actually lower the rates again. Now, this isn't rate rising, but it is giving an indication of cutting back support. And one would suspect that it is more likely to come later rather than earlier, at least until they're confident that the economy is back on track. And now, as we've discovered, and again we mentioned this in a video yesterday, that the coronavirus is taking on a new variant, and we in the United Kingdom have delayed or at least in England, part of the United Kingdom, have delayed the complete reopening of everything and removal of masks by another month because of the concerns about this additional variant. Economists are split on when the actual tapering announcement is most likely, with 1/3 predicting September, 1/3 saying December. Quote, the Fed will continue to signal patience on rate hikes and tapering, despite the recent pickup in inflation and inflation expectations, said Scott Anderson, chief economist of Bank of the West. The Fed will acknowledge, however, that it's making good progress towards its goals. Well, that's the end of the article. There is a little more here, but there's no point actually covering that, to be blunt. However, we're pretty confident that there will be some minor hawkishness on Wednesday. How that will affect markets, we'll wait and see if it happens. If it doesn't happen, then of course we will expect equities to continue rising. And gold and silver too, to some extent. However, the more harsh the announcement, the more hawkish the announcement, then the greater the impact it will have, both on equities and particularly on gold and silver. We don't see it being so dramatic for the simple reason that the Fed knows, based on its history, that it has to be extra cautious in what it actually suggests. Thank you so much for listening. If you haven't already done so, please subscribe to the channel, press the bell sign for you're notified of our videos, and if you wish, please give us a thumbs up, and by all means comment and express what you think may very well happen on Wednesday. We look forward to reading those comments. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.